Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to show you where to start if you want to invest in the stock market. When it comes to investing, it can be pretty difficult to pick a single starting point. There's so many different strategies out there about investing, and learning to invest is a little bit like learning to speak a new language. So once you learn how to speak the language, you can do it for the rest of your life. But getting started is, a little bit of a steep curve. The stock market is literally just a collection of stock. The stock market started, all the way back in, I think, about roughly 1602. In Holland, they had a stock market for the Dutch East Indies Company where people went in and basically bet on whether, the ship would ever come back from India. So that's the beginning of public stock, and it has been developed for many years over that until really about 1850. Public companies started to be created without liability to the people who were putting the money in. Prior to that time, if you lost people's money who invested in your stock, you got to pay it out of your personal funds. But in 1855, they passed laws in England that said, nope, we're going to have limited liability in corporations. And from that moment on, tons of money started pouring into stocks. The public markets are just a place where these stocks are traded once they're registered on the public market exchange. So there's a huge group of companies in America that are all private. They're not available to be purchased by shareholders like you and me. And then there are public companies that are registered and their shares are available in a market. So public companies have sold chunks of their business, not necessarily all of it, but chunks of it, out to people like us and anyone else that wants to buy a sliver or a piece of this business called a share. So that's a stock market. So compound interest is the amount of interest that you earn on your investment, right? So your $100 is earning interest, plus all of the interest that's earned on the investment over time. So your $100 makes $10 of interest, and then the next year you're earning interest on $110, and the next year you're earning interest on $121, and so on like that. Now the effects of compounded interest are incredibly powerful over a long period of time. It's the long period of time that makes compounding very, very powerful. Short periods of time, well, you can see that it adds a little bit, but man alive, when you look at it a long period of time, that interest that you're growing starts to get interest on the interest on the interest on the interest and grows exponentially. They say it looks like a hockey stick. Starts off like this where the blade is and then just goes straight up. Now, when you hear about, people talking like, how is the market doing? What are they talking about? Well, they're usually talking about the performance of an index. That's generally a couple of indexes there that people are talking about. It's the Dow Jones Industrial Index, that's the biggest one, or the S&P 500. Those two are considered to be, quote, the market, all right? Now, the S&P 500 is just 500 stocks that are the biggest stocks out there. And then the Dow Jones Industrial Average are 30 stocks, which are very large stocks. And they're usually changed around a little bit over time. They're not the same ones forever, depending on how those companies are doing. So if the company isn't doing well, it falls off the index, and a new company that's doing better takes over. So the S&P 500 index is 500 stocks out of, roughly 6,000 stocks that are public. Now, if these 500 companies rise in price, then so does the index. And of course, it's balanced based on the amount of stock price for each stock and the weight of that stock in the index. So pretty straightforward, right? Kind of. Now, most people invest in the index funds to be instantly diversified. So index funds or exchange traded funds, ETFs also known as, those things, index funds, ETFs, exchange traded funds, are kind of the same sort of thing. And they provide you with instant diversification. Now that seems like a pretty cool thing, and it is. If you're not going to learn how to invest, buying an index fund or an exchange traded fund is a great way to very quickly diversify your portfolio without paying a financial advisor 1% or 2% of your money to just do that, which is all they're going to do anyway. So, but here's the thing. As Rule 1 investors, we go at it a little differently than that. Okay, we go at it a lot differently than that. We want to find just a few really good businesses to invest in, all right? So instead of buying the 30 Dow Jones Industrial companies at whatever price they're selling for, we want to buy just a few of those companies, maybe 10 or so of them, only when they're on sale. So we're willing to sit in cash for long periods of time and wait until one of those wonderful S&P 500 businesses or Dow Jones businesses, when one of those goes on sale, we want to buy it. And that's because great investing returns come from buying really good companies when they're cheap. I mean, come on, buy low, sell high. How hard is it to figure out how to make money, whether you're going out and buying something in a flea market or you're buying a used car? It's not hard to figure it out. You want to buy the thing for less than it's worth, and ultimately you want to sell it for more than you paid for it. And the thing is, if you can wait patiently in cash, which is the secret to what we do, waiting patiently in cash for the stock market to fluctuate, you're going to have an opportunity to buy these companies many times at a half off sale. Now, if you think about it, if they go on sale at half off, what does that mean? It means when they go back up to where they were, you've just doubled your money. And if that takes 3 years, you're making 26% a year. If it takes 5 years, you're making 15% a year. So what you want to do is you want to buy a wonderful business that's going to be around for the next 10, 15 years, and you buy it when it's on sale. It is not rocket science. Now we talk about something called the 4 M's. The 4 M's are exactly where you've got to start when you want to invest in the stock market. Okay? You want to understand the business that you're buying. We call this the meaning of the business. If you don't understand, I mean, this is so simple, it's darn near brain dead, and most people miss it. If you don't understand the business that you're buying, how are you going to figure out what it's worth if you don't understand it? I mean, it's so simple, it's so straightforward, and people don't think about it. And that's why if you're putting your money with a financial advisor or a fund manager who owns 200 or 300 businesses, do you really think they understand them all? You really think they've even tried? The truth is, you can do this better than professionals because you have advantages in terms of controlling your money that they don't have. And it starts with just focusing on that narrow part of these 5,000 stocks that are out there, that narrow, small little group that you're capable of understanding. All right. Second, you want to find the moat or its competitive advantage that's intrinsic to the company. Now, this is really key. The word's intrinsic, all right? This is what ensures that the business will be around the next 10, 15, 20 years. It's something that's baked into the business itself. And you got to really look for this thing. It's like Burlington Northern, for example. Warren Buffett just bought this company a few years ago. Why? Because it has this huge, durable, intrinsic characteristic that it has railroad tracks from Los Angeles up to Chicago. And if you want to compete with it, you have to put in railroad tracks from Los Angeles to Chicago. How are you going to do that? You can have more money than they can print, and you can't get that kind of railroad track right away. So this is an intrinsic characteristic that makes Burlington durable. And you want to figure that out for the companies that you're looking at, okay? So your company might be the only company around that does what it does. Like there's only a couple of firearm companies left around in the country, right? There's only a couple of aircraft manufacturers. There's only a couple of really good utilities around. So you can find companies that are unique, they've got a special niche, and you're looking for that that's intrinsic that makes it very durable. Now, third thing is you want really good management. I'm telling you, this will kill you. If you don't get this right, you want a CEO that's talented and has integrity. And this is something that makes me absolutely crazy, is that you're putting your money out there in mutual funds, exchange traded funds, and indexes, which means you're spreading your money across everything in the market, which means you're voting for all of these CEOs that are out there doing the kind of stuff that you hate, which means they're paying themselves 400 or 500 times the average employee. They're firing 20,000 people and giving themselves a $10 million bonus. They're going out there and wiping out their company and walking away with $180 million. I mean, you guys, the kind of stuff CEOs do, And the kind of things that boards let them get away with right now has reached epic and horrible proportions. The lack of integrity out there is stunning with these people who are running companies. And the only way I know to fix it is to finally convince you guys you've got to manage your own money and put your money with people that you trust. And there's great people out there, but I'll tell you what, they're getting outnumbered by the people that you're letting your money vote for. You got to stop that and start managing your own dollars, if only to vote for your values. Okay, the last thing is, the fourth thing is you want a margin of safety. That means you got to know the value of the business and you got to know that it's on sale. And guess what? We're right back to the first point. You can't know the value of the business if you don't understand it in the first place. There's no way you can. But if you do understand this business, understand it as well as you'd understand buying the condo next door, I mean, it could be that simple, then you can figure out what its value is and you can figure out when it's on sale. So doing these four things, you guys, is going to ensure that you buy companies with the intention of keeping them from the long term because you bought them on sale and they're great. You don't need to worry about the market over the short term when you buy really great business because you don't care about the market. If the market's going up, that's great. If the market's going down, that's even better because you can buy more as you get more money over time. So next, you're going to need to open a trading account. Now there's a lot of different kinds of accounts, but the two most common kind of accounts are an IRA and a Roth IRA for most of us that are investing. That's because you can get money into those accounts and it'll grow tax-free, for a while anyway. So an IRA or individual retirement account allows individuals like you and me to direct pre-tax income toward investments. That's a regular IRA. So we're allowed to contribute an annual maximum dollar amount to the accounts. I think it's like $6,000 right now. Now you're going to pay income taxes when you withdraw money from the account down the road. You'll pay income taxes on the whole thing, right? But my favorite is the Roth IRA. This is similar to a traditional IRA, but here's the thing, it's a much better deal. The money you put into the Roth is taxed before it goes in. So you won't pay taxes on the money that you take out, ever, which means you can also use a Roth IRA for kind of your emergency account. If you need money, you're desperate to have it, you've got your money working for you, but you can get at it without any penalties. Both IRA accounts can give you more options in the type of investment that you can make with different kinds of benefits. So you do some research before deciding which one's right for you. If you're in a low tax bracket, grab the Roth. If you're in a high tax bracket, and if somebody's matching funds with you, do the regular IRA. The faster you can get one of these accounts and start saving up some money, the faster you get started investing. So here's the thing. You've paid off all your bad debt. You got an emergency fund and you've opened up a trading account. You've found a few wonderful businesses and you're ready to start investing. This is amazing, you guys. It's not rocket science. If you want to learn more about these 4 M's, about trading accounts, about stock market basics, look, we got a lot of stuff out there. We've got an online course for you, which I'll link up to you in the description. Just go click on it, go right over there. It's all for you to figure out the basics of this kind of investing. Now, I'd love to hear from you guys. Are you ready to start investing? Leave a comment below with your answer and I'll be sure and follow up with you. And I want to thank you for watching, so go play. Now, if you enjoyed this video and you feel it was valuable teaching you more about investing in the stock market, hey, please subscribe to my channel and share this video with your friends or anybody that might benefit from this information.